You're checking your investment account for the 100th time this month, watching those numbers crawl up penny by penny. You've got maybe a few $100 invested, earning what feels like pocket change in dividends. But what if I told you that once you hit $10,000 in dividend stocks, everything fundamentally changes? I'm talking about crossing a psychological and mathematical threshold that most people never reach. The average American has less than $1,000 in their savings account, and even fewer have any money invested at all. But here's the thing. That $10,000 milestone isn't just about the money. It's about rewiring your entire relationship with wealth and passive income. At $10,000 invested in quality dividend stocks yielding around 4%, you're looking at roughly $400 in annual passive income. That might not sound life-changing, but it represents something much bigger. It's proof that money can work for you while you sleep. It's the foundation of financial independence. And most importantly, it's the point where compound growth starts to feel real instead of theoretical. If you're interested in understanding how to reach this milestone and what happens when you do, make sure to subscribe to the channel and hit the like button if this information helps you out. Let's be honest about what getting to $10,000 actually looks like when you're starting from zero, especially on a modest income. This phase is brutal. It's the financial equivalent of pushing a boulder up a hill while everyone around you is spending money on things you're forcing yourself to skip. Here's the math that most people don't want to face. If you can invest $200 per month, it takes over 4 years to reach $10,000. That's assuming you're not touching the money and you're getting some modest growth along the way. For someone making $40,000 a year, finding $200 monthly to invest means cutting expenses down to the bone. You're eating ramen while your friends are going out to dinner. You're driving your beat-up car for another year while they're financing new ones. You're saying no to vacations, expensive hobbies, and impulse purchases that everyone else treats as normal. This is where most people quit. But here's what's happening during this slow grind that you can't see yet. Every dividend payment, even if it's just $5 or $10, is teaching your brain that passive income is real. You're building the habit of living below your means. You're developing what researchers call delayed gratification, which is one of the strongest predictors of long-term wealth building. The psychological shift during this phase is massive. You start viewing purchases differently. Instead of seeing that $50 dinner as just $50, you start calculating what that money could earn in dividends over the next decade. You begin to understand opportunity cost in your bones, not just your head. Most importantly, you're proving to yourself that you can stick to a plan even when it's uncomfortable. The average person talks about investing but never actually starts. You're in the small percentage who not only starts but keeps going when the results feel painfully slow. This phase builds the foundation for everything that comes next. Without learning to live on less than you make and consistently invest the difference, you'll never reach that $10,000 threshold where the real magic begins. Here's where everything starts to shift, and it happens faster than most people expect. The moment your dividend account crosses that $10,000 threshold, something clicks in your brain that's hard to describe until you experience it yourself. You're not just looking at numbers on a screen anymore. You're looking at a machine that generates money without your direct involvement. That quarterly dividend payment isn't $5 or $15 like it was in the early days. Now it's closer to $100. And for the first time, you can actually feel the power of compound interest working in your favor. Think about it this way. When you had $1,000 invested, a 4% annual yield gave you $40 for the entire year. That's barely enough to cover a nice dinner. But at $10,000, that same 4% yield is generating $400 annually. That's real money that can pay for groceries, cover a car repair, or get reinvested to accelerate your growth even faster. The psychological validation is enormous. You've proven that the financial advice you've been following actually works. All those months of eating cheap meals and skipping expensive entertainment weren't just sacrifices. They were investments in a system that's now paying you back automatically. But here's the part that will blow your mind. This validation creates what researchers call a positive feedback loop. Success breeds more success. The bigger your dividend payments get, the more motivated you become to keep investing. You start looking for additional income streams not because you're desperate, but because you can see exactly how extra money translates into passive income. Your commitment level changes too. When you had a few $100s invested, it was easy to think about cashing out for some emergency or impulse purchase. But $10,000 represents serious money and serious time invested. You're not going to blow that on a vacation or a new gadget. You're protecting it like the wealth-building foundation it's become. The mental shift goes deeper than just the numbers. You start identifying as an investor, not just someone who's trying to save money. You begin researching companies not because you have to, but because you're genuinely interested in finding the next addition to your portfolio. You're thinking in years and decades instead of months. This is also where the compound effect starts to feel real instead of theoretical. When financial experts talk about money making money, it sounds abstract until you're actually living it. But watching your dividends get reinvested and generate their own dividends creates a visceral understanding of exponential growth that changes how you think about every financial decision. Now let's talk about what that first substantial dividend payment actually looks like and why it represents such a fundamental shift in your financial reality. At $10,000 invested in dividend stocks with an average yield of 4%, you're looking at approximately $100 every quarter. That's $400 per year in passive income. But here's what makes this different from every other $100 you've ever received. You didn't trade your time for this money. You didn't work extra hours. You didn't sell anything. This money appeared in your account because you own productive assets. Let me put this in perspective. The median American worker makes about $20 per hour after taxes. That $100 quarterly dividend represents 5 hours of work that you didn't have to do. Every 3 months, you're getting paid for time you spent sleeping, watching movies, or hanging out with friends. But the real breakthrough isn't just the amount. It's the reliability. Your job might cut your hours. Your side hustle might have slow months. But those dividend payments keep coming as long as you own the stocks. Rain or shine, recession or boom, companies with strong dividend histories keep paying their shareholders. This consistency starts to change how you think about financial security. You begin to understand that true wealth isn't about having a high salary. It's about owning assets that generate income independently of your personal effort. That $400 in annual dividends might not seem like much compared to a $50,000 salary, but it's $400 that doesn't require you to show up anywhere or answer to anyone. The math starts to get interesting when you project this forward. If you can maintain your $200 monthly investment habit, you're not just adding to your principal. You're also reinvesting those dividends, which means your dividend payments start growing faster than your contributions alone would suggest. Here's where most people underestimate the power of what they've built. That $400 in annual dividends, if reinvested, buys you an additional $400 worth of dividend-paying stocks. At a 4% yield, that's another $16 in annual dividend income that you didn't have to work for. It sounds small, but this is how millionaires are made. Small amounts compounding consistently over long periods. The psychological impact of seeing your first real dividend paycheck can't be overstated. You start calculating how many dividend payments it would take to cover your monthly expenses. You begin thinking about what your life would look like if you could replace your salary with passive income. These aren't fantasies anymore. They're mathematical projections based on assets you actually own. This is also where you start to understand why wealthy people seem obsessed with investing. It's not just about growing their money. It's about creating systems that generate wealth without requiring their constant attention. Every dividend payment is proof that your money is working harder than most people ever will. The shift from earning money through labor to earning money through ownership is one of the most important transitions in building long-term wealth. At $10,000 invested, you've crossed the threshold where this transition starts to feel real instead of theoretical. Here's where things get really interesting, and it's something most beginning investors completely overlook. Once you hit that $10,000 threshold, dividend reinvestment plans, or DRIPs, transform from a nice-to-have feature into a wealth-building accelerator that can shave years off your journey to financial independence. Let me break down the math that most people never calculate. When you had $1,000 invested, your quarterly dividend might have been $10. Reinvesting that $10 bought you a fraction of a share, maybe adding $0.40 in annual dividend income. It felt like nothing because, honestly, it almost was nothing. But at $10,000, that same 4% yield is generating $100 per quarter. When that $100 gets automatically reinvested, you're purchasing $400 worth of additional dividend-paying stock every single year without lifting a finger. At a 4% yield, that's an extra $16 in annual dividend income that compounds on top of everything else. Here's the part that will blow your mind. That reinvested dividend income starts generating its own dividends immediately. So you're not just earning 4% on your original $10,000. You're earning 4% on $10,000 plus every reinvested dividend from the past. This creates what mathematicians call exponential growth, but what you'll experience as your dividend payments getting noticeably larger every quarter. The psychological impact of watching DRIP work at this scale is massive. You start to see your share count increasing automatically. Companies you own are literally giving you more ownership in exchange for nothing but patience. You begin to understand why Einstein allegedly called compound interest the eighth wonder of the world. But here's where most people make a critical mistake. They get excited about their growing dividends and start spending them instead of reinvesting them. Don't do this. At the $10,000 level, every dollar you spend from dividends is a dollar that can't compound for the next 20 or 30 years. Think about it this way. That $100 quarterly dividend, if reinvested for 20 years at 7% total return, becomes worth over $400 in today's purchasing power. But if you spend it on dinner and entertainment, it's worth exactly zero in 20 years. The opportunity cost of spending dividends early in your investing journey is enormous. This is also where tax-advantaged accounts like Roth IRAs become incredibly powerful. When your DRIP operates inside a Roth IRA, all that compounding happens tax-free. You're not losing 15% or 20% of your dividend income to taxes every year. Every penny gets reinvested to generate more dividends, which generate more dividends, and so on. The automation aspect of DRIP can't be overstated either. You're not making emotional decisions about when to buy more stock or how much to invest. The system automatically takes your dividends and buys more shares at whatever the current price happens to be. This eliminates timing the market and ensures you're consistently buying more of the companies you already own. Now that you understand how powerful reinvestment becomes at the $10,000 level, let's talk about building a portfolio that can actually sustain and grow those dividend payments over decades, not just years. The biggest mistake I see people make when they reach this milestone is getting greedy with yield. They start chasing 6%, 7%, or even 8% dividend yields without understanding that unusually high yields often signal companies in financial trouble. A 8% yield might look attractive, but if the company cuts its dividend by half next year, you're actually worse off than if you'd stuck with reliable 4% yielders. Here's the framework that actually works for long-term dividend growth. You want a mix of dividend aristocrats, which are companies that have increased their dividends for at least 25 consecutive years, combined with solid dividend growth companies that might not have the 25-year track record, but show strong potential for consistent increases. Think about companies like Coca-Cola, Johnson & Johnson, or Procter & Gamble. These aren't exciting growth stocks that might double overnight, but they're businesses that have been paying and increasing dividends through multiple recessions, wars, and market crashes. They represent the boring consistency that builds real wealth over time. But you also want some exposure to sectors that can grow their dividends faster than inflation. Technology companies like Microsoft and Apple have become reliable dividend payers while still growing their businesses rapidly. REITs provide exposure to real estate income. Utility companies offer stability and modest growth. The key is balance. You don't want all your eggs in one sector because economic changes can devastate entire industries. But you also don't want to over-diversify to the point where you own mediocre companies just for the sake of spreading risk. At $10,000, you have enough capital to build a properly diversified portfolio of 15 to 20 individual stocks across different sectors. This gives you control over exactly which companies you own, while maintaining enough diversification to protect against any single company cutting or eliminating its dividend. Quality control becomes critical at this level. You're not just buying dividend stocks anymore. You're building a machine designed to generate increasing income for decades. Every company in your portfolio should have a clear competitive advantage, strong cash flow, and a conservative payout ratio that leaves room for dividend growth even during tough economic periods. Here's where the math gets absolutely wild, and it's something most people never calculate until they're actually living it. Once you hit $10,000 in dividend stocks, the journey to $50,000 doesn't take 5 times as long as getting to $10,000. It happens significantly faster, and understanding why will change how you think about every investment decision going forward. Let's break down the numbers that most financial advisors don't explain clearly. When you were building toward that first $10,000, you were essentially funding the entire growth through your monthly contributions. Maybe you were investing $200 per month, and it took you 4 years of grinding to reach that milestone. But now you've got $400 in annual dividends working alongside your monthly contributions. If you maintain that same $200 monthly investment habit, you're actually putting $2,800 to work every year instead of just $2,400. That extra $400 might not seem like much, but it represents a 17% boost to your annual investment capacity without requiring any additional sacrifice from your paycheck. Here's where it gets interesting. As your portfolio grows from $10,000 to $20,000, your annual dividends double from $400 to $800. Now you're effectively investing $3,200 per year while only contributing $2,400 from your salary. Your dividends are doing 25% of the work. By the time you reach $30,000, you're generating $1,200 in annual dividends. Combined with your $200 monthly contributions, you're putting $3,600 to work every year. Your passive income is now contributing 1/3 of your annual investment growth. The psychological shift during this phase is enormous. You start to feel like you have a financial tailwind pushing you forward instead of fighting against economic headwinds. Every quarterly dividend payment feels more substantial. You're not just collecting pocket change anymore. You're receiving meaningful amounts of money that accelerate your progress toward financial independence. But here's the part that really accelerates the timeline. Most people who successfully build their first $10,000 in dividend stocks don't stop at $200 monthly contributions. The validation and momentum they've built motivates them to find additional money to invest. Maybe they pick up a side hustle. Maybe they get more aggressive about cutting expenses. Maybe they invest their tax refunds or work bonuses. Let's say you increase your monthly contributions from $200 to $300 once you see how well the system works. Now you're contributing $3,600 annually from your paycheck, plus whatever dividends you're generating. At $20,000 invested, that's $800 in dividends, for a total of $4,400 going to work every year. The math starts to compound rapidly. Instead of taking 4 years to go from $10,000 to $20,000, you might do it in 3 years. And the jump from $20,000 to $30,000 happens even faster because your dividend contributions keep growing. This is also where you start to understand why wealthy people seem to get wealthier at an accelerating pace. It's not because they're making dramatically more money from their jobs. It's because their assets are generating increasing amounts of passive income that gets reinvested to generate even more passive income. The momentum effect creates what researchers call a positive feedback loop. Success breeds more success, which breeds even more success. Your growing dividend payments motivate you to invest more aggressively. Your increasing net worth gives you confidence to take calculated risks that can accelerate your progress even further. By the time you reach $50,000 in dividend stocks, you're generating $2,000 in annual passive income. That's meaningful money that can cover significant expenses or get reinvested to push you toward six-figure territory. The journey from $50,000 to $100,000 happens faster than the journey from $0 to $50,000, even though it represents the same absolute dollar amount. This acceleration principle applies beyond just dividend investing. It's why real estate investors can go from owning one rental property to owning 10 properties in less time than it took to buy that first property. It's why business owners can scale from $100,000 in annual revenue to $1 million faster than they scaled from $0 to $100,000. The key is recognizing that you're not just building wealth. You're building wealth-generating systems that become more powerful over time. Every dollar you invest today doesn't just grow through appreciation. It generates dividends that get reinvested to generate more dividends, creating exponential growth rather than linear growth. And once you hit $300,000 invested, you never have to work again, as I explain in this next video.